Okay, so as I was saying, we talked about this on Tuesday, that bonds are essentially a loan to a corporation. They put these things out there to solicit loans essentially from the public. I mean, we look at it as an investment because we get interest payments, and then at the end of the term, we get our money back. And that's just one of the ways the corporation might raise money that they're needing or wanting for expansion or whatever. They might also sell stock. That's all we looked at last chapter, was issuing stock. So if you're a bondholder, if you had some money and you went today and bought a bond, you become a creditor of that entity. So I have seen, I mean, obviously there's corporate bonds. That's what we're looking at. Have you got the right? Okay. Obviously there's corporate bonds. I've seen churches issue bonds if they need money, school districts, cities, all kinds of stuff. So there's all kinds of different bonds. Or they can have all different types of sources, I guess. So because you're a creditor as a bondholder, if things don't go well or you don't get your money back, you do have the right to sue the corporation to get your money. So that's one of the things they have to think about. But another thing they're thinking about is they don't want their earnings per share to drop too low. So that's what we did last class, was look at different combinations of issuing stock and bonds to see which one looks the best, which one's the best scenario, which one has the best effect on their earnings per share. So go back and watch that if you had. All right. So today, we're talking about specifics that are related to bonds. So from one bond to another, they're going to differ in the face amount. I mean, essentially the face amount is the amount of the loan. Interest rates will be different. Interest payment dates will be different. Whether or not they're supported by, like if the bond's not paid back, is it got some kind of collateral? Will you get something if they don't pay it back? All right, so the face amount of each bond is also called the principal. And that's the amount that you're going to get back at the end of the bond term. So when they mature, you'll get that face amount back. You'll usually see principal or these bonds in multiples of 1,000. So like our problems, our examples and stuff, we'll say, you know, such and such company issued a $450,000 bond. It sounds like it's one bond, but it could be made up of a whole lot of bonds in multiples of 1,000. You know, it's not just one gigantic bond for 450,000. They're going to see if somebody will buy. You know, it's multiples of 1,000. So it's a bond issue. It's like they're issuing bonds at one time in this lump sum, but it's for multiples of 1,000. All right, so interest on these bonds, it might be paid twice a year, quarterly, annually. Most of what we're going to see is semi-annually, which is twice a year. All right, there's a contract that backs these bonds up. It's called a bond indenture. It's going to have the interest rate. It's going to have the interest payment dates. It's going to have the amount of the bond. It's going to have all that kind of stuff on there. So it's like a contract. It is a contract. There's different kinds of bonds or different characteristics of bonds as far as how they are repaid. Term bonds are going to, like, you have one big bond issue. They'll all mature at the same time. They'll all have the same date that they are due. Cereal bonds, and not breakfast cereal. So like serial killer in the first class, and nobody even laughed. Okay, serial killer. It's paid out over several dates, and I mean the amount of the loan. You know, that principal part may be paid out over several dates. Convertible bonds, you can, if you decide you don't want the bond anymore, you can trade it in for stock. And callable means that the corporation can say, hey, we're gonna redeem these now. They can call them back in early. All right. The rest of this stuff, you know, how much money that a corporation gets from issuing or selling these bonds, it's going to depend on a lot of things. What's the interest rate on the market? When you hear market rate of interest, that means if you were to go out and buy a similar bond on the open market, what kind of interest rate could you get on something that's similar to, you know, this corporate bond? You're not going to buy a corporate bond that pays 5% when you can go get another one that's going to pay you 7% of interest. And that's just not, doesn't make sense. Unless you have some kind of incentive, which is that they drop some of the price. All right, so know that the interest rates, the rate that the bond's going to pay is called a contract rate or a coupon rate. The market rate is also called the effective rate. So there's different terminology you need to know on here. Okay, where are y'all on this? Y'all through this first page yet?
See.
All right. So if your corporation's got a bond that pays 5% interest, and yet you could go out and buy a similar bond on the market that pays 7% interest, they're going to have some kind of incentive for you to buy their lower paying bond. So they will sell it to you for less than the face amount. So that's a discount. It's just like discounted clothes or shoes or anything. If they're trying to get you to buy something, if a seller is trying to get you to buy something, they're going to offer you a discount on it. But they're still going to pay you back. That's the thing. If the interest rate's lower, they'll let you buy it at a lower amount, or loan them a lower amount, and then they'll pay you the full amount back. I'll show y'all. It makes more sense when you can actually see it in play. Then on the flip side, if you've got a bond that you have for sale and it's paying a higher rate than you would get on the market, hey, that's a great deal, but they're going to make you pay more for it. So essentially what they're doing in shifting that purchase price is they're selling you a bond at market price, market interest rate, because they're just jiggling the numbers. Reminds me of buying a car. Y'all ever bought a car? Nobody's bought a car? Did you trade something in? No. That makes it easier. Because if you're trading something in and you're trying to negotiate the price of the car, and they wear you down so you're so mentally exhausted that they'll start going, okay, well, we'll drop the price of the car, but we're going to give you less for your trade. So it's like they're doing this and it's not really changing anything. So they're doing this with the price so that you always end up getting market rate of interest regardless, essentially is what they're doing. So if their bond pays less, they'll sell it to you at a discount. And if it pays more, they'll make you pay more for it. But essentially the way it's going to work out is everybody who buys any bond is going to get market interest rate. I hate buying cars. It's miserable. Huh?
I use one for cash.
Well, I did. I mean, the last one I bought was used. It's just.
No, I'm saying like buy it. Don't like just buy one like use for another person. Typically, it's better. We just do like get work done on it if you need to. And
Yeah, the
you're
problem
not having to
is
pay a note.
my route out here to work, I don't want to break down some places.
I mean,
So, you know,
you get good work done, it'll last.
yeah, I mean, if you know
Do your
there's a
research
problem and you
find
get
a
it
vehicle
fixed.
you know is gonna last. You know?
I got an Accord. I mean, it's done.
Exactly.
But I've also had to replace the starter and one of my windows.
Yeah, but you're gonna have to replace parts if you do it, right?
Yeah, but it wasn't. It kind of seemed like it was premature, and it was kind of odd for a Honda. But I could tell it was going out before it went out, so I didn't get stuck somewhere without a car that would crank. With a car that would not crank. So I fixed it before it died, but I was not. I'm glad I knew it was doing it before it. My son's Civic. I mean, I don't think he's even got 50,000 on his. His fuel injector went bad. We had to
What
replace
year
it.
is it?
It's a 17.
Oh, yep, yep.
That year apparently has issues with fuel injection. Y'all three? Where are you?
Almost. It's my Toyota's made before.
If I hadn't, yeah, the Hondas are
Or
historically
Hondas.
pretty.
Hondas or Toyotas before something.
His
Japanese manufacturing is really good.
I kind of go back and forth on the extended warranty thing, but I went ahead and got one on his, thank goodness, because it was like a $1,500 repair. It cost me a whole lot less. All right. Plus is your last one. All right, so here's some recap information on bond terminology, just for you to refer back to if you have questions. All right, so I want y'all to, I hope sharing my screen that this is gonna work. Because I want to watch a video.
Oh,
I don't know if that's going to work or not.
no idea.
I'm going to stop sharing and then I'll reshare it. Am I still recording? That's what I don't know. Here we are. Okay, good deal. All right, I'll reshare my screen when I find the one I want. Go into this class where it is. Up. This week. Is that what we need to know? Yes, okay. Make this larger. Yeah, I gotta go back and, that's not what I wanted to do. I want to make it smaller. I don't have an escape button. All right, I know I got out of this earlier. How did I do
Okay, let's talk about bonds. So they're gonna pay back the money supply
Wait.
account for the
Okay.
$1,000.
What the heck?
All right, so the way that you'll see that written in accounting problems is you'll say it was sold using interest rates. Okay, let's talk about bonds. So if a company wants to raise money, but
Really?
they don't want to give away ownership, then they have this other option of issuing a bond.
Make this
What
smaller.
this does is it borrows money from the
More.
public. So for example, this is a McDonald's bond, and it's a $1,000 bond.
I need
Which
to
means
share
that
my screen.
McDonald's is wanting to borrow $1,000 from the public, and in exchange, they're
I'm
going
not
to
in the
pay
mood for
back
this
an
today.
interest of 4 to 4. Listed right here, 4
How do I shrink this thing?
bonds. So if a company wants to
Stop.
raise money,
Stop.
but they don't want to give away ownership, then they have this other option of issuing a bond. What this does is it borrows money from the public. So for example, this is a McDonald's
I did
bond,
not have this
and it's a
problem
$1,000
earlier.
bond.
What's the deal?
Which means that McDonald's is wanting to borrow $1,000 from the public, and in exchange, they're going to pay back an interest of 4 to 4%. It's listed right here, 4 to 4%. And so at the end of 10 years, they're going to repay the $1,000. And up until then, every 6 months, they're going to pay interest on this. So that's what a
How do I
bond
escape out of this?
place you
I
get.
don't want you doing this right now.
Okay, let's talk about bonds. So if a company wants to raise
This
money,
is a nightmare.
but they don't want to give away ownership, then they have this other option of issuing a bond. What this does is it borrows money from the public. So for example, this is a McDonald's bond, and it's $1,000 bond, which means that McDonald's is wanting to borrow $1,000 from the public, and in exchange, they're gonna pay back an interest of 4 1/4%. It's listed right here, 4 1/4%. And so at the end of 10 years, they're going to repay the $1,000. And up until then, every 6 months, they're gonna pay interest on this. So that's what a bond is. So once you have issued a bond, you got a contract here. You've written on the bond what you promise. They're promising to repay $1,000 at 4 1/4%
I
interest
just-
rate. That's
Y'all
your
are just gonna sit
contract
there and
rate.
play on your phones and not help an old lady out.
Contract rate.
I mean, really?
Because no matter what, every 6 months, McDonald's is gonna pay back
Huh?
4 1/4% times a half a year.
There's no
The reason
stop
why
or
I say that
anything.
is because 4 1/4% is an eighth.
There it is.
There we go. Okay. Jeez. Now where is it?
On the left. Right there.
There we go. Okay. So I need to share the screen again. I'm not sure what's gonna happen here. Is it sharing that one? I don't know. I guess so. Let's hope. Okay. Now. How do I make it play? This is a nightmare. I did not have this problem before. Must be y'all. I don't know what the deal is. I'll play it in YouTube. Just play it. She makes good sense out of it. That's why I liked that video, but now I can't get it to act right. This is irritating.
Okay, let's talk about bonds. So if a company wants to raise money, but they don't want to give away ownership, then they have this other option of issuing a bond. What this does is it borrows money from the public. So for example, this is a McDonald's bond. And it's
Yes, you're supposed to be
$1,000
watching
bond,
this.
which means that McDonald's is wanting to borrow $1,000 from the public, and in exchange, they're going to pay back an interest of 4 1/4%. It's listed right here, 4 1/4%. And so at the end of 10 years, they're going to repay the $1,000. And up until then, every 6 months, they're going to pay interest on this. So that's what a bond is. So once you have issued a bond, you've got a contract here. You've written on the bond what you promise. They're promising to repay $1,000 at 4 1/4% interest rate. That's your contract that you've made. We're going to call that the contract rate. Because no matter what, every 6 months, McDonald's is going to pay back 4 1/4% times a half a year. And the reason why I say that is because 4 1/4% is an annualized interest rate, and they're going to pay it twice a year. And then at the end of the term, that is at the end of, for example, 10 years, they're going to give back the original $1,000. So that's our contract rate. Now, if the interest rate in a market is still 4 1/4, then this is easy to account for, and I'll tell you why. If the contract rate, the 4 1/4, is equal to the market rate, that is, if you were to go out into the marketplace, you could still get a bond for 4 1/4%, then this bond will be sold at face value. That means it's just sold for the $1,000. All right, so the way that you'll see that written in accounting problems is you'll say it was sold at 1, or it was sold at 100%. So you would say $1,000 times 100% or times 1 gives you the amount that you would sell this bond for. Somebody would give you $1,000, you pay them interest every 6 months for 10 years, and then you'd repay the $1,000. Very easy to account for. However, market interest rates change daily for a variety of reasons: supply and demand, contraction of money supply, the Federal Reserve changing interest rates to do with the economy and stimulating the economy. So all these things change our interest rates. So they rarely are exactly the same as what was printed on the bond. So we still pay the same amount every 6 months, but we tweak the price up front. Here's what I mean. If the contract rate is less than what the market rate is, that is, if you went out into the market, you could get more money Well, then would you want a McDonald's bond that paid 4 1/4% if you could go out into the market and get a bond that was paying, for example, 10%? No, this wouldn't be very attractive to you. So in order to sell it, they have to discount it. So we call that a discount. That is, if the contract rate is less than what you could get in the market, it's sold at a discount. The way you would see that written is anything less than 100%. So if I write in, for example, 0.97, then I would see that I would sell this bond for $970. Okay, market interest rate. We're not going to do that calculation. That calculation is actually done through present value tables, future value tables. But just know that when we arrive at this 97, it was an exact calculation to give the bondholder exactly market interest rate. Okay, so let's look at the third example. Contract rate is greater than market rate. Under this last scenario, this bond becomes very attractive. Now we can get 4 to 4%, but in the regular marketplace, you get less than that. So this bond is attractive, but McDonald's is not going to sell it to us unless they can true it up to the actual market rate. And in order to do that, they're going to have to actually sell it at what we call a premium, which is anything greater than 100%. So for example, you could look at this as 1.04, and if you multiply across, you would see that the bond holder would have to pay $1,040 for it. So what's important to note is that as far as the corporation and as far as the bondholder goes, it doesn't matter if it's sold at face value at a discount or a premium, because regardless, you're always going to get the market value, the market interest rate at the end of the day. So next we'll learn how to take what we've just seen here and put it into journal entries.
Get this out of here.
Okay, class, sorry, I'm having to re-record this part of the class because when I got out of that video, I was showing y'all that the other instructor had recorded. I did not share my screen, so I'm going to run through what we covered in class, and so maybe it'll be a little bit shorter for you anyway. So the point she was making in that video is that regardless of what price a corporation is selling their bonds for, whether they're selling them at a discount or a premium, the whole purpose for that discount or premium is to true up the effective interest rate they're going to get to the market rate. So if their bond is paying less, then they'll give the investors a break on the purchase price. So essentially what's happening is they're recouping their interest on the end, and I'll show you that in just a second. So let's look at this first example here. This is issuing bonds at face amount. So this is when the market rate and the contract rate, so the rate that the bond has on it to pay in interest payments throughout the life of the bond, the market rate and that rate are the same. So in that case, there will be no premium, there will be no discount. So on January 1st, Mountain Outfitters issues a $700,000 5% 5-year bond that pays semi-annual interest. Okay, so this means twice a year. And this $700,000 right here is your face amount. So this is the loan amount essentially. And this $700,000 represents one entire bond issue, meaning that you'll more than likely have multiple investors that will buy increments of $1,000 of this large group of bonds. So it's not just one huge $700,000 bond, it's a bond issue. You can buy increments of 1,000 of it if you want to invest in this company. If you want to become a creditor to this company and loan them money. Okay, so this is your contract rate. This is the rate of interest that will be paid twice a year to investors on this bond. It's a 5-year bond, so that means it will mature at the end of 5 years, and the investors will be paid back the full $700,000. You know, to all the investors will be repaid at that time.
So let's do the entries on this. So the first entry we are to record is the issuance of the bonds. So on January 1, we will debit cash for $700,000 and we'll credit bonds payable for $700,000. Now, one thing I want you to note is we will always credit bonds payable for face amount. Always. Because regardless of the purchase or, the purchase price that the investors are paying, sales price that the corporation is selling them for, this is the amount here that will be paid to those investors at maturity date. So when these bonds end, that full face amount is going to go out to those investors. All right, so the next thing we are to do is to record the interest payment. I've got a formula down here for you to help you do that. We'll take our bond face amount of $700,000, plug in our interest rate, and this right here gives you $35,000. Then divide that by 2 because there's 2 payments per year. And that will give you $17,500 that will be paid out twice a year. Okay, this is going to go out on June 30, and I want you to note this date for your homework because in Cengage, they just tell you to journalize the first interest payment. They don't tell you the date, and that can get a little confusing because you're a little unsure if it's June 30 or is it July 1st or what is the date. And if you're not thinking about it being in even increments of 6 months, that might get confusing. That's a very common question I get. So we'll debit interest expense and credit cash for that interest payment. And then the third entry they want us to make is to show what it looks like when the payment of the principal goes out on the maturity date. So we don't have a specific date for this, so I just have labeled it C so you'll know what it is. But we will debit that liability of bonds payable for $700,000 and credit cash for the full amount. Okay, the next one is one that I want you to try on your own. So if you just want to pause the video and just give it a shot, I will put the solution on there for you. And you can check yourself to see how you did. Okay, so here's your solution to the example 2 that I wanted you to work. You're going to debit cash and credit bonds payable for the full face amount. Then here is your interest expense calculation. And remember, when you multiply the face amount times the percentage, that's an annual percentage rate. So we have to divide that by 2 because they're paying it twice a year. So once the year's up, they'll have the full $125,000 in interest paid, but we don't want to show more than we should in one particular payment. And then to show the maturity of the bond, we'll debit the liability and credit cash. All right, so issuing bonds at a discount. The next problem we look at is where bonds are issued at a discount. So bonds are going to be issued at a lower price when the market rate is higher than the contract rate. So in this particular problem, they're telling you what the market rate is, but it's more for illustration purposes than anything else. On the first day of the fiscal year, Neely Distributors issues a $400,000, so there's your face amount, 3% contract rate, 5-year bond that pays semi-annual interest. So we know there's 2 interest payments per year. The market rate of interest at the time of the bond issue was 5%. So there is a 2% difference between what an investor can get on a similar bond on the open market as opposed to this particular bond that's paying 3%. So this bond's paying less interest. Why would you invest in a bond paying less interest when you could get one that would pay you more? So to attract investors to purchase your bond, you're going to have to do something to make it more appealing. So in order to determine what our discount amount is, we will take this face amount of 400,000, subtract out the sales price that they gave us right here, and the difference is going to be your discount. So that amount is $35,008. Now what that represents is the difference between these two interest rates. You've got 5% minus 3%. So I mean, it may not work out just perfectly right, but that's what the idea is. So this discount represents that difference. So while the investors paid a smaller amount up front for the bond, when they get their principal at maturity, they're actually going to collect a full 400,000. So essentially what's happening, when they get their interest payments, they'll receive 3% in their interest payments. But at the end of the bond, they'll receive the rest of it, this 35,008. So it's almost like they're collecting that 2% difference on the back end when they get the principal paid out at the full 400,000. Okay, so we figured our discount. We need to journalize the bond issuance. So we'll debit cash for the amount that was collected. We'll credit bonds payable. I would suggest always skipping this line, because if you can't remember which way a discount or a premium goes, debit or credit, you're best off skipping that so you don't end up having to rearrange things for Cengage. So my bonds payable, remember, will always be my face amount. And then the difference is going to be the discount. And we'll put that on the debit side because we need to balance this entry. So discount on bonds payable goes here. Okay, so the next one is for you to work. So pause this, go ahead and work it, and I'll fill it in for you and you can check your solution. Okay, your solution to example 4 is here. You will debit cash for the amount of money received. You will credit bonds payable for the full face amount. And you will debit discount on bonds payable for the difference that you have to calculate between the face amount and the amount that the bond was sold for. Okay, so issuing at a premium. Bonds are going to sell at a premium when the market rate is less than the rate that this bond is paying. So again, you've got the market rate listed here just for illustration purposes, but I did that intentionally so that you could see, you know, why there is a premium being collected on this one. So on the first day of the fiscal year, Eskimo Ice Company issues an $800,000 base, 8% contract rate, 5-year bond that pays semi-annual interest, which means twice a year. So the market rate at the time of the bond issue was 7%. So market rate 7, but your bond pays 8. Well, that's a good deal. But the corporation didn't get to the point they were of success that they are working at without having some sense. So they're not going to sell it to you for $800 and pay extra interest. They're going to sell it to you for a little more. So what you're doing here, let's figure out what the premium is. In this case, we'll put the proceeds first and then subtract out the face value just to see how much our premium is. It's just the difference between the two. So essentially what's happening here, you've got contract rate of 8%. You've got market rate of 7%. So there's a difference of 1%. So what's happening is the investors are going to pay that difference up front, because when they get paid interest, they will get paid 8%. So they're getting a higher interest rate, but they're paying that difference up front in the price of the bond. So to journalize the issuance of this bond, we're going to debit cash for the amount collected. We'll credit bonds payable for the face amount. and then we will credit premium on bonds payable. Okay, so the next one is one for you to work. So give that one a shot, pause it, whatever, and I'll have the solution for you. Okay, here's your solution to example 6. You'll debit cash for the amount of cash collected, the sales price. You'll credit bonds payable for $6 million, the face amount. And then the difference, since you're collecting more than the face amount, is a premium. And so we'll credit that premium. Remember, you've always got to have your entry balancing, so make sure all of your debits in total equal all of your credits in total. Okay, so for the next part, I put those answers up for the class to copy down if they wanted to. So what I'll do is I'll complete these pages for you, and you can look in the module for those answers if you want to copy those down.